Silver could surge. COMEX may have just confirmed it. Something just moved inside the world's most powerful silver exchange. And almost no one is talking about it. Not the headlines, not the analysts, not even the traders watching the ticker in real time. But deep inside COMEX, a signal just appeared. The kind that doesn't show up often. The kind that, historically, shows up just before silver stops being ignored and starts being unstoppable. The question isn't whether this move is coming. The question is, will you see it before it's already gone? Welcome to the hidden currency, where the real story of money is told before the mainstream catches up. Now, before we go any further, if you haven't subscribed yet, think of it this way. You wouldn't leave the house in the morning without putting on your glasses, would you? Subscribing to this channel is exactly that. It helps you see clearly in a world that is deliberately kept blurry, so hit that subscribe button. Consider it your reading glasses for the global economy. And one more thing, where are you watching this from today? Drop your city, your country, your corner of the world in the comments below. Because the people watching this channel are not ordinary viewers. They are thinkers, builders, decision makers, and we want to know exactly where in the world you are standing today. Silver could surge. COMEX may have just confirmed it, and the story of why that matters begins not on Wall Street, not in a boardroom, and not in a government press release. It begins inside a system that most people have never heard of, a system that quietly controls the price of one of the most important metals on the planet. That system is called COMEX, and right now, something inside it is shifting. Most people look at silver and see a number, a price on a screen, a percentage up or down. They check it the way they check the weather, quickly, casually, and then they move on. But the people who truly understand silver, the institutional players, the long-term strategists, the ones who have watched this market through multiple cycles, they do not look at the price first. They look at the structure beneath the price. Because the structure always speaks before the price moves. And right now, the structure is speaking loudly. To understand what is happening, one must first understand what COMEX actually is. The commodity exchange, known as COMEX, is the primary marketplace in the United States where silver futures contracts are bought and sold. It is the engine of price discovery for silver. When the world wants to know what silver is worth, it looks to COMEX. Banks look to it, mining companies look to it, industrial buyers look to it, governments reference it. It is, in every practical sense, the heartbeat of the global silver market. But COMEX is not a simple marketplace. It operates on a layered system that most casual observers never bother to examine. On one layer, there are futures contracts. These are paper agreements, promises to buy or sell silver at a specific price on a specific future date. Millions of these contracts exist at any given time, and the vast majority of them never result in actual physical silver changing hands. They are traded, rolled over, and settled in cash. This is the paper layer of the silver market. On another layer sitting beneath all of that paper activity, there is physical silver, real metal, bars stored in certified vaults. And within that physical layer, there is a critical distinction between two categories. The first is called registered inventory. This is the silver that is fully available and ready for delivery against futures contracts. It is the metal that backs the promises. The second category is called eligible inventory. This is silver that is stored at COMEX facilities, but has not been made available for delivery. It sits in the system, but it does not back the contracts. This distinction matters enormously, and right now, as of April 2026, the relationship between these two layers is sending a warning signal that serious market observers cannot afford to ignore. Open interest on COMEX silver is elevated. Open interest refers to the total number of active futures contracts currently outstanding in the system. When open interest is high, it means a large number of market participants are exposed to silver price movement at the same time. More contracts are in play. More money is at stake. More pressure is building inside the system. That alone is worth noting. But here is where the story becomes genuinely important. While open interest has remained elevated, registered inventory, the physical silver that actually backs those contracts has not been growing at the same pace. The number of paper promises in the system is large. The amount of physical metal available to fulfill those promises is comparatively tight. That gap, that imbalance between what is promised on paper and what actually exists in deliverable form is precisely the kind of stress condition that has historically appeared before silver makes its most significant price moves. This is not speculation. History has recorded this pattern with remarkable consistency. In the summer of 2020, silver was trading near $12 per ounce. The structural conditions inside COMEX were showing early signs of stress. Physical demand was rising, paper exposure was high, and then the move came. Silver surged from $12 to nearly $30 in a compressed window of time that caught the majority of market participants completely off guard. Those who had read the structure saw it coming. Those who were only watching the price were left reacting after the fact. Then in early 2021, the Silver Squeeze episode brought COMEX back into public conversation. Physical demand spiked dramatically. Premiums on coins and bars rose sharply. Registered inventory came under visible pressure. For a brief but revealing moment, the system was tested in plain sight. Today, the conditions building inside COMEX carry echoes of both those moments. But there is one critical difference this time, and that difference changes everything about what may be coming next. There is an old principle that serious investors have understood for generations. Markets do not move because of what people see. They move because of what people do not see. And what is quietly being constructed inside the COMEX system right now is something that the majority of retail investors, casual traders, and even many financial commentators have completely missed. Not because the information is hidden, but because most people simply do not know where to look. To understand the architecture of what may be coming, one must go beyond the price chart and into the mechanical framework of how COMEX actually functions under pressure. When futures contracts begin to accumulate faster than physical inventory expands, the system enters a condition of structural tension. Think of it this way. Imagine a bank that has issued far more withdrawal promises than it holds in actual cash reserves. As long as everyone remains calm and no one rushes to withdraw at the same time, the system operates normally. But the moment a significant number of contract holders decide they want actual delivery, actual physical silver instead of a cash settlement, the system faces a stress test it may not be fully prepared to pass. That is the condition quietly forming inside COMEX today. The registered inventory numbers tell a story that paper prices have not yet reflected. Registered silver, the only category of metal that can be legally delivered against an active futures contract, has remained relatively constrained, even as the volume of active contracts has stayed elevated. The ratio between open interest and deliverable supply is stretching. And in the history of silver markets, when that ratio stretches far enough, something eventually forces it back into balance. That rebalancing process is rarely slow, it is rarely quiet, and it is rarely kind to those who are not prepared for it. Now layer on top of that structural tension the most closely watched data set in the professional commodity world, the Commitment of Traders Report, commonly referred to as the COT report. Published weekly by the Commodity Futures Trading Commission, the COT report breaks down futures market positioning into distinct categories of participants. Among the most significant of those categories is the commercial participants group. These are the entities closest to the actual production, processing, and consumption of silver. Mining companies, industrial users, major financial institutions with deep silver exposure. In the investment community, this group is widely referred to as the smart money, not because they are always right, but because their positioning historically tends to align with where the market is actually heading over the medium to long term. What the most recent COT data is showing is that commercial participants have been quietly adjusting their exposure in a manner that historically precedes periods of significant volatility. They are not making loud public announcements. They are not appearing on financial television programs to explain their thesis. They are simply repositioning methodically and deliberately in a way that suggests they see something forming on the horizon that the broader market has not yet priced in. At the same time, speculative positioning in silver is notably not crowded. This detail is critically important and is frequently misunderstood by those who are newer to commodity market analysis. When speculative positioning is excessively crowded on the long side, it typically signals that a market has already been discovered, that the easy move has already happened, and that the risk of a sharp reversal is elevated. But when speculative positioning remains measured and restrained, while commercial participants are quietly building exposure, it signals something far more powerful. It signals that the market is in the early stages of a structure-driven move, not a hype-driven one. Structure-driven moves tend to be larger, more sustained, and more difficult to exit once they are fully underway. This combination, elevated open interest, constrained registered inventory, smart money repositioning, and the absence of speculative crowding, creates what experienced market analysts would describe as a compression setup. The market is coiling. Pressure is building from multiple directions simultaneously, and compression setups in silver do not resolve gradually. They resolve with force. Consider what happened during the two historical episodes examined in Part 1. In both 2020 and early 2021, the structural warning signs appeared well before the price reflected them. The participants who understood COMEX mechanics, who read the COT data carefully, and who recognized the imbalance between paper exposure and physical supply were positioned before the move began. The participants who waited for confirmation from the price itself entered late, paid higher prices, and in many cases watched the opportunity compress and close before they could fully capitalize on it. The architecture being built inside COMEX today does not resemble a market preparing for calm. It resembles a market preparing for movement. And the most important question for any serious investor or strategic thinker watching this unfold is not whether that movement is coming. The question is whether they will be early enough to matter when it does. There is a moment in the history of every important asset when the world stops seeing it for what it was and begins understanding it for what it has become. Gold had that moment centuries ago. Oil had that moment in the 20th century. And silver, quietly and without much public fanfare, is having that moment right now, because silver is no longer simply what it used to be. It has evolved into something far more complex, far more strategically important, and far more difficult to replace than most people currently understand. And that evolution is about to collide with a supply reality that the market has not yet fully priced in. For most of recorded financial history, silver occupied a relatively straightforward role. It was money. It was a store of value. It sat alongside gold as one of the two metals that human civilization consistently trusted to preserve wealth across generations and across borders. Empires minted it into coins. Central banks held it in reserves. Ordinary people saved it as a hedge against the inevitable erosion of paper currency. That monetary identity never disappeared. It remains very much alive today, particularly in an environment where currency debasement concerns are rising, where geopolitical tensions are reshaping global trade relationships, and where a growing number of serious institutional voices are openly questioning the long-term stability of the existing dollar-based monetary framework. But something fundamentally changed in the past 2 decades. Silver developed a second identity, and that second identity is arguably more powerful than the first because it is driven not by sentiment, not by fear, and not by financial positioning. It is driven by physics, by engineering, by the irreversible direction of global industrial civilization itself. Silver is now a critical input in the production of solar panels. Every photovoltaic cell manufactured anywhere in the world requires silver. There is currently no commercially viable substitute that matches silver's electrical conductivity at the scale and efficiency that modern solar manufacturing demands. And the global solar energy expansion is not slowing down. It is accelerating. Government commitments across Asia, Europe, and the Americas have locked in solar infrastructure spending at levels that virtually guarantee rising silver consumption for the foreseeable future. The International Energy Agency has consistently projected solar capacity additions that, when translated into raw material requirements, point towards silver demand figures that the current mining industry is structurally unprepared to meet. Beyond solar, silver's role in electrification is expanding rapidly. Electric vehicles require silver in their electrical systems, battery management components, and charging infrastructure. The global transition away from internal combustion engines, regardless of the pace at which it unfolds, represents a sustained and growing source of silver demand that did not exist at meaningful scale even 15 years ago. Every charging station installed, every electric bus commissioned, every grid upgrade completed in support of electrification adds another layer of industrial silver consumption to an already tightening demand picture. Advanced electronics represent yet another dimension of this industrial demand story. Semiconductors, high-frequency circuit boards, medical devices, defense systems, and next-generation communication infrastructure all rely on silver in ways that are deeply embedded in their manufacturing processes. As the world's appetite for sophisticated technology continues to grow, the silver consumed in producing that technology grows alongside it. This is not a cyclical trend, it is a structural one. And structural trends do not reverse simply because a quarterly earnings report disappoints or a central bank adjusts its interest rate guidance. Now place that relentlessly growing demand picture next to the supply side of the equation, and the picture becomes significantly more serious. Global silver mining output has not accelerated at a pace that corresponds to the demand growth being generated by these industrial sectors. New silver discoveries have become increasingly rare. Existing mines are aging. The lead time between a new silver deposit being identified and that deposit producing meaningful output is measured in years, sometimes in decades. Capital investment in silver mining has been inconsistent, partly because silver prices have historically been volatile enough to discourage the long-term infrastructure commitments that expanding supply would require. The result is a supply-demand dynamic that is unlike anything the silver market has experienced in its long history. In previous eras, silver demand was relatively predictable and relatively elastic. If prices rose, demand would moderate. Industrial users would find workarounds. Consumers would buy less. The market would rebalance. But today's industrial demand for silver is largely inelastic. Solar manufacturers cannot simply decide to build panels without silver because the price has risen. Electric vehicle producers cannot redesign their electrical systems overnight because silver has become more expensive. The demand is locked in by technology, by infrastructure commitments, and by the physical laws that make silver irreplaceable in the applications that now depend on it. This dual identity, monetary metal and industrial necessity, creates a uniquely powerful demand profile. On one side, macro uncertainty and currency concerns drive investment and safe haven demand. On the other side, the unstoppable expansion of clean energy and advanced technology drives industrial consumption. Both forces are pulling on the same constrained supply at the same time, and the COMEX structure examined in the first two parts of this analysis sits directly at the intersection of those two forces, absorbing the pressure from both directions simultaneously. The market has not yet fully priced this convergence, but the data suggests it is getting closer to doing so. Every market cycle in history has contained a moment that, when looked back upon with the clarity of hindsight, appears completely obvious. The warning signs were visible, the data was available, the structural conditions were measurable, and yet the majority of participants either missed it entirely or understood it too late to act with any meaningful advantage. The silver market in April 2026 may very well be one of those moments, and the difference between those who recognize it now and those who recognize it later could be measured in something far more consequential than a simple percentage gain on a trading screen. To understand what the data is actually saying, one must first understand what a confirmed breakout in silver would structurally require. A genuine breakout is not simply a price moving higher on a single session. It is not a headline number that generates brief excitement before fading back into the previous range. A confirmed breakout is a condition where price moves decisively above a established resistance level, where volume and open interest support the move rather than contradict it, where physical demand begins to visibly reinforce what the paper market is signaling, and where the broader macro environment provides the fundamental backdrop that makes the move sustainable rather than speculative. Right now, the conditions for precisely that kind of breakout are assembling with a quiet deliberateness that experienced market observers recognize immediately. The technical picture for silver in April 2026 is one of compression near historically significant levels. Silver futures have been testing the upper boundaries of a range that, if broken convincingly, would represent a structural shift rather than a temporary spike. The price action has been characterized by higher lows, a pattern that technically indicates that sellers are losing their ability to push prices back down to previous levels. Each time silver has pulled back in recent sessions, it has found support at progressively higher levels. That is not random market noise. That is the fingerprint of sustained accumulation by participants who have decided that lower prices represent an opportunity rather than a warning. Institutional positioning patterns reinforce this reading. When large, sophisticated participants accumulate a position in any market, they do not do it in a single visible transaction. They do it gradually, methodically, and deliberately across an extended period of time, specifically to avoid drawing attention to what they are building. The COT data reviewed in Part 2 of this analysis shows that commercial participants have been engaged in exactly this kind of patient, deliberate repositioning. They are not reacting to news, they are anticipating structure, and when the smart money begins anticipating structure in a market that is already showing the kind of COMEX stress signals outlined in Part 1, the historical record is remarkably consistent about what tends to follow. What tends to follow is a move that is fast, compressed, and deeply unforgiving to late movers. This is perhaps the most important practical reality that any serious investor or business decision maker needs to internalize about silver specifically. Unlike equity markets, where a breakout can sometimes be tracked over weeks and months with multiple entry opportunities presenting themselves along the way, silver breakouts have historically been violent in their speed and narrow in their window. The 2020 surge from $12 to nearly $30 unfolded in a matter of weeks. The 2021 squeeze episode generated its most significant price action in a matter of days. Those who were positioned before the move captured the full magnitude of the opportunity. Those who waited for confirmation found themselves chasing a market that had already made its most significant move. The risk of waiting in the current environment is therefore not simply the risk of missing a percentage gain. It is the risk of watching a structural opportunity close before the broader market even fully understands what opened it. Because once a COMEX stress condition resolves, once the imbalance between paper exposure and physical supply forces a rebalancing, the price adjustment that follows tends to happen faster than most participants are practically capable of responding to. By the time the financial media is explaining why silver surged, the move has already happened. By the time the retail investor reads the headline and opens a brokerage account, the institutional participants who read the structure weeks earlier are already considering their exit. For the business community, for the aspiring entrepreneur, and for anyone who manages capital with a genuine understanding of macroeconomic risk, the current silver setup carries implications that extend well beyond a simple investment thesis. Silver's dual identity, as both a monetary safe haven and an industrial necessity, means that a significant price move in silver would not occur in isolation. It would signal something broader about the state of the global monetary system, about the pace of industrial transformation, and about the growing gap between what financial markets are currently pricing and what the physical world is actually demanding. The data is not screaming. It rarely does before the most important moves. It is speaking in the measured, precise language of structural imbalance, institutional positioning, and compressed supply-demand dynamics. The COMEX signal that has emerged in April 2026 is not a guarantee. No signal in any market ever is. but it is the kind of confluence of structural, institutional, and fundamental factors that serious decision makers cannot afford to dismiss simply because the broader market has not yet reacted to it. History does not reward those who wait for certainty. It rewards those who read the structure, understand the risk, and act before the window closes. The window right now appears to still be open, but windows like this one have a well-documented habit of closing far faster than anyone expects them to. The silver market is not asking for attention, but the data strongly suggests it is about to demand it.